companies are having trouble finding workers. They have to bid up wages. To what extent does this potentially exacerbate an inflation problem that the Fed may have to deal with down the road? Do you even have wage push inflation?
That's an important question, and I think we're going to have to study it and watch how the numbers roll out. There are a lot of factors at work. I mean, let's look back and notice that labor share of income has gone down over a very long period of time, and they went down during the last recession. After the great financial crisis, every time we get back to a business cycle peak, labor share is less, and so it would not be unusual over a longer swing for labor share to increase, and so that would represent higher wages. That's a bargaining situation. That depends on the occupations, the jobs that workers are looking for, and I think they're looking longer term for what the kind of jobs that might be serious endeavors for them over the next 5 years, not the next 3 months. And so I think businesses have to be very careful, think about job matching, think about the value proposition, and it's not going to be easy. So I think it's going to be hard. Now those are wage increases. Is that inflation? I think that's the labor market adjusting, and we'll have to pay attention to its inflationary implications. And accommodative monetary policy helps with that job matching, but some of that is relative prices. It's not going to lead to sustainable inflation over a few years.
So talking just about that headline in the Wall Street Journal today about prices for everyday goods really soaring. We see the inflation numbers that are out there. So I really have two questions. How temporary do you think this inflation run is going to be? And how much tolerance do you have if we start printing numbers of 3% and 4% annual increases? Does that begin to cause you concern and think perhaps it's time to reverse policy?
I think we're going to have to be looking at that. We certainly expect that this increase in relative prices, goods that had fallen, in their pricing during the COVID shutdown, now they're going up. They're going up by more as there isn't enough supply for a lot of goods. If you're looking for household appliances, they're hard to come by. There's just a long list of things where prices and long queuing for getting them delivered has increased. Once they get production back up, and I would expect prices to be about where they ought to be. And so, I think there can be a relative price increase, and then I think beyond that, that's what real inflation is. Beyond a relative price adjustment, year after year, are they going to continue to go up very strongly? The evidence seems to be that inflation expectations are going to be very important for that. So I think we're going to have to be looking at the financial market implications for inflation expectations, survey measures, and thinking about whether or not we're delivering on our 2% on average inflation objective over time. I think we've got a ways to go, but we'll have to be, paying attention to whether or not inflation gets up above 2.5%, 3%. To average 2%, you've got to be above 2% for some period of time. So inflation rates of 2.5% don't bother me, as long as it's consistent with averaging 2 over some period of time.
Shepard Smith here. Thanks for watching CNBC on YouTube.